Monetary policy statement for the month of August 2013. Annual inflation picked up in July 2013. Headline and core inflation rose to 5.1% and 6.4% from 3.6 and 5.8% respectively in June 2013. The increase in annual inflation is attributed to food prices, particularly the price of processed foods, which are likely to be transitory. In contrast, annual and monthly non-food inflation remained virtually unchanged in July 2013. Monthly core inflation edged down to 0.4% in July and remained consistent with achieving an annual rate of core inflation of 5% over the medium term. Real economic growth is forecast to increase to 6% in 2013-2014. However, downward risks to economic growth remain. The decline in private sector imports in the first 6 months of 2013, coupled with relatively subdued pace of credit creation, suggests a softening of aggregate demand. The decline in lending rates from 27% a year ago to 22.6% in June 2013 will contribute to increasing private sector investment and a strengthening of economic growth over time, which is consistent with achieving the inflation objective. Therefore, economic activity is projected to gradually regain some momentum in the latter part of 2013-2014, and projections of medium to long-term growth paint a robust economic growth. As was indicated in July 2013 policy statement, risks to the inflation outlook remain on the upside. The growing inflationary pressures originate from the domestic supply side, along with the prospect of increases in oil prices due to geopolitical factors in the Middle East and North Africa region. Demand pressures remain moderate and still do not pose a risk to the inflation outlook. The Bank of Uganda forecasts suggest that annual headline and core inflation is likely to increase slightly in the next 3 to 6 months, largely driven by the effect of drought on domestic food production and food prices. Nevertheless, the impact of drought is expected to be temporary. Once these effects dissipate annual inflation is expected to fall back and stabilize around the Bank of Uganda target of 5%. On the basis of the current assessment of the global and domestic economic conditions and outlook, and given that the 12-month forecast for core inflation is very close to the Bank of Uganda target of 5%, a neutral monetary policy stance is warranted. Therefore, the Bank of Uganda will keep the central bank rate at 11% in August 2013. The band on the CBR will be maintained at plus or minus 2 percentage points on the CBR, and the margin on the rediscount rate at 3 percentage points on the CBR. The rediscount rate and the bank rate for August 2013 will therefore remain at 14% and 15% respectively. Monetary policy going forward will continue to be guided by the objective of anchoring inflation expectations around the medium-term target of 5%, while mindful of the needs to support economic growth. I thank you very much.